one thing we learned is that as interest rates go down, the demand for money goes up. In other words, people are more willing to hold cash because it doesn't pay as much to invest, it doesn't pay as much to save, and you can borrow money more cheaply. And so the thing that happens as well as interest rates go down is the money supply goes up. And we learned that a couple of days ago because every time a bank makes a loan, that increases the money supply, right? And so, when you deposit $10,000 in the bank, if the reserve requirement is 10%, they will loan out 9,000 and keep 1,000. And then of that 9,000, it'll get loaned out. It'll get deposited back in either that or another bank. They'll keep 10%, loan out 8,100. And then of that 8,100, they'll keep 10%, loan out, 70, 200 and some change. You get the point. Eventually, the money multiplier states that 1 divided by the reserve ratio, which right now is 10%, every time you make a loan at a bank, it could lead to a 10 times growth, or make a deposit in a bank, it could lead to a 10 times growth in the money supply if all of the available excess reserves are loaned out. All the available funds are loaned out and then deposited and then loaned back out. So when interest rates are low, people are more likely to borrow money. If people are borrowing more money, that increases the money supply and thus creates inflation. Okay. The reason why is, what we talked about yesterday, where lower interest rates lead to more investment spending. It also leads to people in businesses expanding their business, but it also leads to people, borrowing money to buy houses and buy cars and things like that, make big purchases. So we're going to look at a theory today called monetarism. Okay, and a lot of what we looked at before was the Keynesian theory. We're going to come back to that a little bit here, but a lot of what there's a new theory we need to learn about called monetarism. Okay, and monetarism is based on the idea that the money supply directly determines changes in prices. Okay, and that's one thing we talked about really for the last few weeks, is that the inflation is always a function of an increase in the money supply. Okay, inflation is always what we call a monetary phenomenon. When the money supply increases, the price level goes up. When the money supply decreases, the price level goes down. Okay, so monetarism is based on this very simple exchange, what we refer to, or equation, what we refer to as the equation of exchange. MV equals PQ. Okay, so MV equals PQ. Okay, the M stands for the money supply, the amount of money that is out in circulation. V is the velocity of money. That's how much each dollar gets spent. That's how many times each dollar gets spent. P is the price level, the CPI, and Q is the real GDP. You will also see Y used for that. Y is often used as a substitute for real GDP. Q means quantity, same thing. You will see, so the price level times real GDP equals money times velocity. So here's what we can generally assume, okay? That velocity and quantity are relatively stable, okay? We can generally assume that these two things are the case. The velocity and quantity are relatively stable in the monetarist theory. So because velocity and quantity are stable, then they're fairly unchanging. As one goes up, the other will go up as well. So as a result, because those are stable and thus they're both constant and cancel each other out, M, the money supply, equals P, the price level. Okay, that's the basic idea behind monetarism. And so the key behind the equation of exchange is that it expresses that the value of what people spend is equal to the amount of things they buy. Okay, the value of what we spend is equal to what we buy. And what that means is value is subjective and based on what people are willing to spend on an item. Okay. Value is not determined by how hard the workers worked or how much we as a society, how important we think their job is or how many hours were spent working on it. That does not determine value. The consumer ultimately determines value based on how much the consumer is willing to pay for a product. Okay. How much we value things is equal to the amount of things we buy. Okay. So the quantity theory of money then basically states that changes in the money supply directly lead to changes in prices, changes in the overall price level. So the reason for that is when we increase the money supply, you have more dollars chasing the same amount of goods and services at that fixed point in time. Thus, prices will rise. Okay, and go back to this graph here real quick. Increase the money supply, we see inflation go down, or we see the interest rate go down. When the interest rate goes down, there's more money then going into circulation, obviously. Thus, inflation goes up. You have more dollars chasing the same number of goods and services. What that does is it makes those goods and services more scarce and forces prices up. Okay. And so what a monetarist believes then is that the money supply should be kept at a steady rate and should not be used as a tool to try to influence the economy. We shouldn't be manipulating the money supply to, say, influence aggregate demand. We should keep the money supply stable, should keep the inflation rate stable, and the inflation rate is really the most important thing to target in the economy, because if we keep inflation low and prices stable, then everything else will generally fall into line. Okay. So obviously that if we increase the money supply, it leads to inflation because you have more dollars chasing the same number of goods and services. If you decrease the money supply, as the Fed did in from 1929 to 33, then you have fewer dollars chasing the same number of goods. Therefore, your prices fall. Okay. So, and again, the monetarist view of the equation of exchange is that velocity and quantity are constant. Okay. That real GDP and velocity are constant. Okay. And so as a result, money supply increases in the money supply equal increases in the price level. Therefore, an increase in the money supply equals inflation. Okay. So, now here's where we generally, here's where people generally disagree. Okay. Monetarists today, especially modern monetarists, say that the velocity is not necessarily a fixed amount, but it is predictable. Okay, you can predict the velocity. Monetarists believe that keeping the money supply stable then is the key to avoiding both inflation and unemployment. Keep the money supply stable and then generally encourage a supply side fiscal policy, lower taxes and cut government spending, and that will generally keep unemployment low, but also keep inflation low. But the key to making that happen is keeping the money supply stable. Okay. And so there's some monetarists that believe in a fixed money target. Okay. That the money supply should grow at a fixed rate regardless, basically almost like we were on a gold standard. Right now, the Fed has discretion as to how much to increase or decrease the money supply. And the Fed will increase the money supply if it feels like we're in a recession and needs to grow the economy. It'll decrease the money supply if it feels like we're in an expansion and we need to curb inflation. If inflation's a problem, they'll decrease the money supply. Otherwise, the Fed generally tries to grow the money supply, but only at a slow and steady rate Now, the inflation rate lags the money supply. The increase in money comes first, and generally investors get their hands on that money first, and then inflation follows. Okay. And so what is a monetarist likely to expect to happen here as we have seen a dramatic increase in the money supply over the last few months. At the beginning of March, our money supply was about $15 trillion. Okay. By July, it was 18 trillion. Today, it's almost 19 trillion. Okay. So our money supply has grown by about 20% in the last, 10 months, 11 months. And much of that has been due to increased Fed borrowing, or increased government borrowing, and the Fed buying up bonds, and thus pumping money into circulation to try to kind of deal with the effects of the springtime pandemic recession. Now, the inflation rate has been fairly low during that time because, again, it lags the increase in the money supply, and also because the economy has been somewhat held down a little bit by the fact that people are not able to, shop and go out to restaurants and do entertainment and, things that we would normally do and spend our money on. Things like people aren't really going to movie theaters or sporting events, or restaurants very much. And a lot of times you put those things together, right? You may go out to dinner and a movie. Well, dinner may be done at home and the movie may be watching Netflix. So, and so we're not spending as much money, and obviously fewer people have jobs as well right now. So, the unemployment rate is still fairly high, or higher than it was in January. So because of that, there's less money being spent. And so that has somewhat lagged the increase in the money supply. But over time, this dramatic increase in the money supply, as the economy gets back to normal, and that's probably going to happen in the next 6 months, as as the coronavirus vaccine is widely distributed, as people get it, and as we also just kind of achieve natural immunity as well, due to the fact that, people have gotten exposed, they've developed antibodies, whatever the case, the fact that we will be, the fact that we will likely be past a lot of this in the next 6 months, we'll probably have the economy back to normal, I would think, by summer. And I think by then we are in danger of seeing some pretty significant inflation because of this. And so, it's been masked a little bit by the fact that so much of the economy has been shut down. And again, the economy is not a monolithic thing that you could turn on and off like a light switch. The economy is the millions of individual transactions that happen, but a lot of those individual transactions are not happening right now. Businesses are not sending people out and having in-person meetings. They're meeting on Zoom instead. That has really hit the travel industry, the hotel industry, the airline industry. People aren't going to restaurants as much. And that's not because of government shutdowns necessarily. That's just because people are voluntarily choosing not to do so, because they're trying to prioritize their own health and safety. Okay. So let's kind of revisit the three theories again. Okay. And we've looked at classical and Keynesian theory when it came to fiscal policy. Okay. And fiscal policy, classical economists are kind of in the modern version of that is the supply side economists, where we want to keep taxes low, keep government spending low, and keep the government kind of out of the economy. The same thing holds with monetary policy as well, that we generally are looking for long-run stability, okay? And as a result, the government, and in this case, the government's bank, the central bank, their job is to get out of the way, okay? To get out of the way and let the economy do its thing. So we should not be necessarily manipulating the money supply to try to bring about some kind of economic growth or end of the recession or allow for large amounts of inflation, okay? basically what classical economists believed is that the economy is stable at full employment, and that is the natural place for an economy to go. And the economy is always going to default to full employment as long as people get out of the way, because again, the invisible hand will guide us to the jobs that are most efficient for other people, and most efficient, therefore, for the economy. So what causes inflation is excess money supply. An increase in the supply of money leads to an increase in prices, okay? And so as a result, if we are manipulating the money supply, if we're increasing the money supply by, say, artificially lowering interest rates, or doing what the Fed is doing right now by buying lots of bonds, that what it will do is it will change prices and thus change aggregate demand. That it will boost, lowering interest rates will boost aggregate demand, which will lead to inflation, okay? And the reason why, okay, is let's go back to our aggregate supply and demand graph here, okay? Okay. Remember, the long run aggregate supply curve is kind of J-shaped, okay? During recessions, we're kind of in this, if we're below full employment, we're kind of in this lateral phase. But when it comes to monetary policy, the belief is that because the natural spot for an economy is full employment, any increase in the money supply will increase aggregate demand, but the economy at full employment cannot really absorb any more aggregate demand. And so as a result, the result is not economic growth, not an increase in real GDP, but an increase in prices, inflation. And so generally, there's no real belief that fiscal policy, that government spending or raising taxes or lowering taxes will really affect the economy much. It's more of a fact that inflation is caused by excess money supply, and if the government, as long as the government stays out of the way, that the economy will always default to full employment. So as a result, a classical economist believes that the money supply should be kept stable and markets should be allowed to work. Now, there's an offshoot of the classical theory known as the Austrian theory that basically takes that to another level and advocates for either, yes, keep the money supply stable, but also take it out of the hands of the central bank. And some Austrians and many advocate for a return to a gold standard or some kind of fixed standard to keep the money supply stable, to keep the scarcity of money, and again, to allow the free market to work, okay? So I'm going to skip over to the monetarist view because it's basically an updated version of the classical view. Monetarism was popularized by Milton Friedman in the middle part of the 20th century. And again, his belief is that the economy finds its stability at full employment. The economy always defaults to full employment. And so he believed, however, that inflation was caused by short-run price and wage adjustments, that prices and wages will change in the short run, like, for example, the oil shock of the 70s caused prices of everything to go up, and thus wages adjusted as well. That was a short-run thing. But as well, that prices are influenced by excess money supply, that inflation is initially caused by short-run price and wage adjustments, but in the long run, excess money supply, the money supply really is what determines the price level, and thus really determines economic growth as well. And so monetary policy, again, if we increase the money supply, it will cause inflation while also boosting aggregate demand. But again, if we're at full employment, which is where the economy is stable, that it's just going to cause inflation. Okay, increasing the money supply only causes inflation. It does not cause economic growth. Now, like the classical economists, the monetarists believe that government spending, a stimulus check, for example, that everybody's talking about right now. We need a stimulus check. That government spending really does not, in the long run, overall affect the economy. And the reason why is the crowding out effect. Yes, the government will spend money that may cause a short-term boost, but in the long run, the government borrowing required to finance that, okay, will affect interest rates and thus crowd out private investment and thus crowd out investment in more productive sectors of the economy to basically go to the government to buy bonds to pay for things that we bought several years ago. And as a result, it will not, in the long run, boost the economy at all. So, cut taxes, raise taxes, increase government spending, tax the rich, it's not going to have any effect on the overall economy. Okay? It's just not. Because in the long run, there's a crowding out effect, that the government spending crowds out private spending and thus prevents those private actors from growing the economy. So essentially what the government spending does is, instead of boosting the economy, it just displaces private spending. And again, we know that governments do not spend money as efficiently as the private sector does, because governments do not have the same incentives. Okay. Again, the incentives in government are to get reelected. The incentives in the private sector are to not go out of business, right? You have to serve customers to not go out of business. To get elected, you have to serve a very, very small subset of voters to tip them to your side, because they'll bring a bunch of other people who may or may not like your policies with them, just because your policies are less bad than the other person's policies. Okay. Now let's come back to the Keynesian viewpoint. Okay. And remember that Keynes is a believer in demand side economics, stimulating aggregate demand. And so he believed that at anything below full employment, that the economy is fairly unstable. And so he called for very significant government intervention in the economy. So what Keynes believed is that wages and prices are fairly sticky. And so it is government spending that is needed to try to boost the economy. Okay. He believed that if we have inflation, okay, go back to the equation of exchange, MV equals PQ, he believes that velocity is unstable. And so if we have inflation, it's because of aggregate demand. Okay. If inflation isn't high enough, that just basically, if inflation is low, that just means that the economy is not doing well. There's not enough aggregate demand. And so basically what Keynes believed is that, especially at below full employment, we have to boost aggregate demand. And by doing so, we will have economic growth, and it will pick up the slack in the economy that is happening because we have lots of unemployed people. And so as long as we try to boost economic growth, as long as we're below full employment, we will have economic growth without inflation. Okay, so go ahead and boost the money supply, lower interest rates to boost aggregate demand, to get people to spend money and thus benefit businesses. Okay, now what that does is it lowers interest rates, which obviously increases economic activity now, and it essentially displaces economic activity that would happen in the future and makes it happen now to try to get us out of the recession. Okay, and so lowering the interest rate boosts aggregate demand, which boosts real GDP, because again, as we saw earlier, lower interest rates means more business investment, more people are going to buy houses, more people are going to buy cars, whatever. But once we get to full employment, that's kind of where the classical economists come back and say, hey, keep the interest rates low, and all you're going to do is cause inflation. Now, Keynesians generally do not consider inflation to be a problem. Okay, inflation they see as a trade-off with unemployment. And the more important of those two is keeping unemployment low and economic growth high. And so Keynesians are willing to tolerate a little bit of inflation as long as it means that there's economic growth and unemployment is low. And not only that, they kind of prefer it a little bit because, again, they believe that the economy is boosted by aggregate demand. And as a result, when you put money in people's hands, they're going to spend it. And when people are spending money, that boosts aggregate demand, that boosts the GDP, that boosts the economy, that boosts economic growth. Keynesians do not want people to save money. They want to encourage people to spend money. And whether that's through government spending and sending out stimulus checks and, creating government programs and, building bridges and roads and things like that, or if it's lowering the interest rates so people have more money to borrow, either way, the government should be actively involved to a Keynesian in kind of directing and guiding and manipulating the economy. But the problem is that eventually you run out of tools, okay? Because again, when you do that, you try to encourage spending now through low interest rates. Well, at some point, everybody who wants a house has one, right? At some point, everybody who wants a car has one. And so what do we got to do? We got to lower interest rates even further. Well, at some point, you lower interest rates to zero, and that's pretty much where we are now. The federal funds rate is 0.25%. And so then you kind of run out of tools that you can use, okay? And so, and at that point then, again, once people have enough stuff, you can't really keep encouraging people to spend money. And thus a recession happens. And again, according to Keynesians, how you respond to a recession is you inflate the money supply, as we saw this summer and this spring when we looked at that graph of the money supply. So Keynesians believe that the government should be active in using interest rates and government spending to stimulate aggregate demand and get the economy to full employment. Okay, but again, there are trade-offs to that because, again, the low interest rates cause inflation in the long run, and the government spending requires more borrowing and higher taxes, which slows the economy in the long run. So, the Keynesian view kind of creates a short-term jolt, but at the long run slows the economy down. Whereas the classical and monetarist views maybe don't provide as many short-term solutions, but in the long run leads to a stable economy and generally slower and steadier economic growth rather than kind of this roller coaster of expansion, recession. Okay. And so we've generally, really in a lot of ways, in the last 40 or so years, we followed kind of the classical view in fiscal policy, which is the supply side view, although we have kind of adopted Keynes's lust for deficits. But we have largely, I would say, adopted a more Keynesian view of monetary policy, of keeping interest rates low. And I anticipate that we will probably deal with some kind of inflationary crisis, or we could deal with some inflationary crisis in the future when we get back to full employment as a result of that. So again, just to wrap up, the classical and monetarists, and you could kind of throw the Austrians in here, although they're a little bit different than the monetarists, they're a little closer to the classical, basically believe that inflation is caused by a growth in the money supply, and that inflation will then obviously slow the economy down and cause problems, discourage saving, and stifle long-run economic growth. Okay, so classical and monetarist, again, they're thinking about long-run growth. Inflation is caused by increases in the money supply, and so the government and the central bank should largely stay out of the way and allow the money supply either to be fixed or grow at a very slow and steady and predictable rate. Whereas Keynesians believe that the government should be very active in the economy, that the government should be managing the economy. And on the monetary side, that means that the government, in this case, the central bank, again, the Fed is independent of the government, but its presidents, or excuse me, its governors are all appointed by the president. But they believe that the central bank should be actively involved in managing the economy by managing interest rates, by increasing bond purchases to keep interest rates low, to try to jolt the economy. And if inflation happens, so be it. inflation's not a problem. Inflation to a Keynesian is the sign of a healthy economy. And so that's really the balance between the Keynesians who believe the central bank should be active in increasing the money supply, and the monetarist and classical and Austrian economists who believe that the central bank should not be active and should just keep things very steady to allow the economy to grow at a predictable rate.